When trading, the large profits are made when the market is making large breakout moves. It's hard to get large profits if the market is flat. So, what if there's an indicator that can actually predict exactly when a price breakout is coming before it even occurs? Well, that indicator is the ATR. If you are not using the ATR indicator as part of your trading strategy, then you are missing a gold mine. It's literally the best indicator. Why? Because it can measure the most important metric on trading, which is volatility. And in this video, I'm revealing the best way to use the ATR indicator. And as a bonus, I'll also tell you how you can set your stop loss using the ATR indicator. And also, a very important money management strategy. So without further ado, let's get started. The ATR indicator stands for Average True Range, and its only purpose is very simple: to identify the volatility on the market. So when you open the ATR indicator, you'll get a single line. But believe it or not, you don't really need this line, because the only important part of the indicator is the ATR value, the number in the corner. So this number shows the average pips on the market in the past 14 candles. You can switch this to whatever value you want in the settings, but I prefer the original. So you can see here, this means that in the current market, the average pips of the last 14 candles is 53 pips. So the higher the value, the more volatile the market is, and the lower the value, the less volatile the market is. But disclaimer, the ATR does not measure the direction of a trend. Just because the ATR is heading upwards doesn't mean that the price is uptrending. So now, I'm revealing the best way to use the ATR indicator. So like I said in the start of the video, the big profits are made when the market has a high volatility. So it's important for us to know when a market is volatile. What you need to understand is that the volatility of the market is constantly changing from low volatility to high volatility and vice versa. So we know that if the market is on a low volatility period, it means that somewhere in the future, we will see an increase in volatility. Luckily, using the ATR, it tells you exactly when the market is on a low volatility. So here's what you need to do. First, you pick a time frame. In this case, I'm using the 30-minute chart. And next, what you need to do is zoom out of the chart a little bit. You can see that the ATR is constantly switching from lows to highs. So now, what you want to do is find the relatively lowest point. It doesn't have to be the exact low, just pick one that is low enough. So now, you point at it using your mouse to reveal the ATR value. Now we know that in this time frame, a relatively low ATR is considered at around 23 pips. Obviously, if you chose a higher time frame, the value would be much higher. But in this time frame, it's about 23 pips. So now we know that once the ATR drops down to somewhere around 23 pips, volatility will start to pick up soon. And high volatility means bigger price movements. It's now easier for us because we already know that somewhere in the future, the price is going to break out, but we just don't know the direction yet. Remember, a high ATR value means the price can either break out upwards or downwards. So now, your only job is to predict the direction of the breakout. There's actually a lot of ways you can do this, but my favorite method is using a trend indicator such as the Heikin Ashi. So you can see in this example, the ATR is on a relatively low value, and the Heikin Ashi displays multiple green candles, meaning that the breakout is most likely to happen in the upwards direction. And that's exactly what it did. It went upwards and you would have secured some profits. Here's another example. You can see that the ATR is at a relatively low value, which indicates that a breakout might happen. Now, you can see that volatility is actually starting to pick up, and the Heikin Ashi is displaying huge red candles, meaning that the breakout will likely happen to the downside. And that's exactly what happened. So that's how you use the ATR to predict when a price is breaking out. So now, I'm going to show you exactly when to exit a trade to get as many profits as possible using the ATR. So when trading, have you ever encountered this kind of problem where, for example, let's say you received a long signal here, and let's say because you normally use a 13 pip stop loss, you also decided to use it here. But the price instead drops downwards and hits your stop loss only for it to go back up again. So you've closed your trade early and missed the trend. If you would have put your stop loss just slightly below here, it will not get triggered and you would have participated in this trend. So how do we avoid situations like this? So knowing that different markets have different levels of volatility, do you think it makes sense for us to use the same stop loss for all of them? Of course not. Because if a market is more volatile and you put a small stop loss, 9 times out of 10 it will most likely get hit. But if the market is calm and less volatile, a smaller stop loss would make much more sense. So what you need to do is use the multiples of the ATR to determine your stop loss depending on your risk tolerance. For example, let's say your entry indicator displays a long signal here, and at this specific point, the average pips of the last 14 candles is 24. So you can actually put your stop loss based on that number. In this case, 24 pips. But if you have a lower risk tolerance and think that 24 pips is too much and you want a tighter stop loss, you can divide that value by 2. So you can also put your stop loss at 12 pips. So it all depends on your risk tolerance, but it needs to always be a multiple of the ATR. Another example would be this. Let's say you received a short signal from your entry indicator, and the ATR value is 14. So you can put your stop loss at 14 pips. But if you think that 14 pips is too small for your risk tolerance and you want a higher stop loss, you can multiply that value by 2 to make it 28 pips. It all depends on your risk-reward ratio as long as it's still a multiple of the ATR. So, back with our first example. If you actually placed your stop loss based on the ATR, which is around here, instead of just making up a random number, it wouldn't have closed the trade too early and you will still participate on this rally. If you want to use the ATR as a trailing stop loss, you can use an indicator called the chandelier stop. This indicator is also based on the ATR. It is designed to keep traders in trend until a reversal happens. So, you can close your trade when a candle hits the chandelier stop. And disclaimer, this indicator is not designed for entry positions. You don't want to take long or short positions based on this indicator. If you want a similar indicator that is actually designed to detect trends, you can use the super trend indicator instead. So now, I'm revealing an important money management strategy that you can use with the ATR. So let me give you a scenario. Let's say you're trading and the current ATR value is 20 and you're risking, let's say, $100 on this trade. So my question is, do you think it makes sense to risk that same $100 but on a trade which has a 60 ATR? No, because it's more risky. That's like saying you would risk the same amount of money when investing in the S&P 500 and Bitcoin. Obviously, you want to lower your budget for the more volatile investment. So you need to optimize your trading budget based on the volatility on the market. So instead, what you actually want to do is this. Let's say per trade, you are risking $100 on a market with 20 ATR. If next time you want to trade with a market that has a higher volatility of, let's say, 60 pips ATR, since it's 3 times more volatile than the first one, that means you want to put your capital 3 times less. So in this case, you would only put $33 on a market that has 60 ATR. And you don't have to worry about getting little profits. Because remember, the market is 3 times more volatile, so it has a higher chance of making bigger movements. So even with less capital, you'll still get decent amounts of profits. So I just revealed the best strategies that you can use with the ATR indicator. And all I ask for in return is a very small favor of liking the video and subscribe to the channel. It literally takes only 2 clicks, but it means a lot to me. So thank you guys for watching, and I'll see you in the next video.